Hello, everyone, and welcome to Fundamental Auditing, Chapter 11. Chapter 11 is on the revenues, receivables, and receipts process, as well as the cash account balance. So chapters 11 through 14 are going to explain the different type of cycles there are. So this one's going to be revenues, there's going to be purchases, the financing and investing. So these chapters are going to go through what type of audit procedures that you would have on like the revenues, the receivables, the receipts process, and the cash account balance. So what type of procedures in terms of test of control procedures, as well as substantive procedures. So these chapters 11 to 14 are important for you to understand when going through the audit. How do you audit revenues? How do you audit receivables? You will be expected to produce audit procedures that will be used on certain accounts depending on what the company is. So first thing that has to happen is the auditor must understand the process. So the auditor needs to understand the business method of generating revenues and of how they record those revenues, right? So how do they generate it? What are the steps in the process? And then eventually, how do they go on to record it? So we have to understand the revenue, receivable, and receipts process, see how it all flows together in order to be able to develop procedures around them. And we want to make sure that we go through the assertions, so existence, ownership, completion, valuation, disclosure. We keep in mind all management's assertions because that's going to help us determine what our audit procedures are going to test. So in the textbook has a lot of exhibits that you're going to need to refer to when trying to go through this chapter. So activities are included in the revenue, receivable, and receipt process for general companies is first you're going to receive and process customer orders. Then you're going to deliver the goods and services to the customers. You're going to bill the customers and then account for receivables. You're going to collect the cash and deposit it. And then you're going to reconcile the bank accounts. Okay, so just if I pull up the exhibit, it kind of goes through. So if you just start here, it goes through the steps in the typical activities that you would do when somebody wants to buy something or a service. So for what the revenue cycle is like, so you start here, there's a customer order. Customer does a purchase order or they sign a contract. There's going to be something that they do. So either they'll fill in an order or they'll sign a contract or go through something. Then maybe there's like credit granting in there as well. So maybe there's credit files or credit reports if it's not just a simple cash transaction. Then you would have to go to like the warehousing, shipping, and delivery. So you want to make sure that there is, let's go down, that there is actually inventory for them to give to the customer, right? So you look at the inventory records, you would have a shipping document. So you would have that as well, right? You would bill the customer. So you would have a sales invoice to the customer, sales invoice, you would probably set up an accounts receivable, right? Have the customer order in there, the shipping documents, those should all be flowing together. And then any monthly statements to the customer if they haven't paid on time. And then you're going to collect the money, hopefully. So you would do the cash collection, the customer payments. You're going to deposit the money in the bank. You're going to look at cash receipts transaction file and match it up with the bank statements. So the accounts that are included, there's many accounts that are included when going through the revenue cycle. So cash in bank, cash receipts, accounts receivable, allowance, bad debt, revenue, sales returns, allowances, and discounts. You have to keep that into consideration, and then the inventory records as well. Okay, so a lot goes into the whole revenue cycle, and that's something you have to understand as an auditor before you can do the procedures. So you can only do the audit, develop audit procedures after you've gained an understanding of the process. Okay? So each company is different on how they, like what type of documents they use for the customer orders, and do they do a credit file or not? What does their sales invoice look like? So how do they collect the cash? Stuff like that. Okay, so that's you need to gain an understanding of that first and foremost. So just kind of going through each of the processes and what kind of controls that companies should have in place when they're going through the revenue cycle. So when a customer order is received, there should be a number of authorizations that should be required. So you could look at the customer status, the credit status. Is there availability of inventory? So does the availability of inventory need to be verified before a sales order can be created? So if someone's ordering something, does somebody have to approve that there is inventory available before the sale can go through? The purchase price for the sale needs to be determined as well. So maybe there's a master price list that is followed. Maybe it's through negotiation, but does somebody go through and do an authorization of the negotiation? So you need to figure that all out. Once approved, there should be a sales order and a packing slip, and inventory may be updated for the commitment of the goods, right? So shouldn't keep the inventory as available inventory that can be sold to somebody else if somebody else is already, if you've already opened a sales order for that person. So you probably have to, somebody will have to show that the inventory is being used for a sales order. Then you want to look around the custody of the inventory. So the actual physical custody of the inventory is wherever the inventory is kept, either in a stock room or a warehouse. So who has custody of the inventory? And the custody of the inventory should be transferred to the shipping department when there is an authorization of the packing slips. If the stock keepers or the shippers have the ability to change the quantities shown on the packing slip, then there is a weakness here in segregation of duties. So if they can change quantities in the packing slip, then they can change it to a lower quantity and maybe keep some for themselves or something. Right, so we want to make sure that there's a separation of duties and not the same person that has created the packing slip isn't the same person that has the custody over the goods. And then custody over accounts receivable, we need to think about that too. So receivable balances, you need to determine who can alter those by entering transactions such as returns or allowances or write-offs, right? So somebody could set up a return, but then maybe the goods never come back. Maybe the goods get kept by the person who set up the return. And so there needs to be, somebody making sure, people are responsible for each area to make sure that there can't be fraud happening. And then the recording. So when the shipment is complete, there should be several documents that are created. So a bill of landing, which shows evidence that the goods have actually delivered. Sales invoice that bills the customer for the goods. That open sales order should be closed. Somebody who has the ability to enter, alter, and physically intercept the sales invoice may have, like, if they can alter the sales invoice and put like a higher number or a lower number. Maybe they put a lower number because their friend is the one buying the inventory or something like that. So you want to make sure that duties are segregated, so no one person is doing everything. And then there should be periodic reconciliation. So a comparison of the total unpaid balances to the accounts receivable is a common reconciliation, right? So maybe every week, every couple weeks, every month, somebody does compares the total unpaid balances to the accounts receivable account. And this person should have no responsibility over authorizing the sale, custody, or recording. So it should be a separate person doing a periodic reconciliation that does not have responsibility over any other part of the revenue process. Okay. And then you can do an age trial balanced for this reconciliation. You can do like an accounts receivable aging to determine like what balances are over a certain amount of days to see if you're going to actually get the money. And then cash receipts and cash balances. So once you've received the cash, most companies don't really have too much authorization to accept payments from customers. So cash can be received in many ways. It could be over the counter, like maybe a fast food restaurant or a retail store. It could be through mail, it could be a lockbox, it could be an e-transfer, electronic funds transfer, right? It could be through credit card or debit card. So there should be authorization required for approving any discounts, any returns, any allowances. Okay? At some point, someone's going to have cash or checks in their hand, and that person's going to have like the physical custody of the cash. So there should definitely be a number of controls considered when for that person who will have the custody of cash. So how do you know they're not going to just pocket the cash? So there needs to be like rotation of staff, technological controls, insurance. At like a fast food restaurant, for example, you something that some restaurants have implemented is a sign that says if you don't get a receipt, you get the meal for free. So this will prevent someone not putting in the information in the cash register and just taking the cash, right? So if a fast food employee just takes the cash and pockets it, then doesn't input anything into the system for a receipt to come out, then the customer is going to say, hey, don't I get this for free because I don't get a receipt? So that's something that some maybe you've seen a sign like that in some places that accept cash, and that is why, because to not have the employee just pocket the cash. So there needs to be, ways, controls, and some creative things that you have to do to make sure that fraud can't exist in your company. And then looking at recording and periodic reconciliation of the cash balances, the accountants who are the ones that are recording the cash should not also be the ones that are handling the cash. Okay, so somebody, there should be separate people. So a separate person should receive the cash, separate person should record the cash, and then a separate person should deposit the cash. That way, one person can't just take all the cash and not record something, or record less than there should be. Cash should be recorded using remittance lists. The cash account and accounts receivable account should be reconciled and updated. So if you receive the cash from the customer, then the accounts receivable account should be updated to reflect that. Bank reconciliations need to be prepared at least on a monthly basis, and the person that's preparing the bank reconciliation should be different from the person that is reviewing the bank reconciliation, right? And the bank reconciliation should be done by someone who does not have the responsibility for recording the cash or collecting the cash. Okay. A paid check should be compared to the disbursements journal to show that these are actually just in the disbursements journal. Okay, so a lot of things go around like the cycle. So the revenue cycle, companies have to figure out what can we do in the revenue cycle to make sure that there's controls in place so that the fraud cannot occur by the employees or by the customers. And us as auditors need to be able to understand the whole cycle, all the steps that are involved, because we need to gain an understanding of the internal control environment. And once we do that, we'll learn of what the control risk should be and whether we should test controls, and also help us determine for substantive procedures how much of a sample do we get based on control risk and then detection risk. So when we're looking at audit evidence of what to test and what type of evidence that we need, we can look at the order master file. We can look at the credit check files to if there is a policy that all customers need to have a credit check before a sale order can be open. We would do that check. Look at the price list master file and compare it to the invoices. So compare what was actually billed to what the price list is, the master file price list. to determine if the correct amount was billed. We'll look at the sales detail or the sales journal file. We can compare when things were shipped to when it showed up on the sales journal, if it was on the same date, to make sure that there's nothing included from like a next period or a prior period. We would look at the sales analysis reports, look at by product line to see how many of one particular product has been sold, or by employee, and then investigate any unusual items. Like if an employee, records a sale or something on a Saturday, but the stores are closed on Saturdays, then that's an unusual item that you would want to investigate further. Looking at the accounts receivable age trial balance, so looking at assessing for bad debts. So is there any bad debts that should be recorded that aren't? And then looking at the cash receipts journal, looking at deposits, receipts, the bank statements, comparing everything, looking at the bank's reconciliation that was done, and comparing all that. So we would do a control risk assessment. We'd first try to understand what internal controls there are around the revenue cycle. This will help us determine how many substantive procedures that we're going to do. The account balances that are affected by revenue is already what I discussed on the exhibit, but they're all here again. So these are all the accounts that are affected by the revenue, receivable, and receipts process. So when looking at doing a control assessment, you as the auditor want to make sure that there is proper segregation of duties in place. Make sure there's bonding of key employees. You want to make sure that there's policies and business rules for how they do everything. You can find out a bunch of information by doing like an internal control questionnaire, or doing a walkthrough, or even observing. So my example of a fast food restaurant, the auditor can come behind the counter and watch some transactions happen, and they can see what are the controls. If somebody is going to do a return, does the employee do the return, or does the supervisor have to come and authorize the return, or a discount or something like that? So we can find out all this stuff by asking questions, doing an internal control questionnaire, doing a walkthrough, doing observation. If we're going to test controls for the sales, cash receipts, and receivables accounts, the test of controls should address all of those control objectives that are in Chapter 9. Cutoff is important to the revenue cycle. So cutoff here, you're making sure that the revenue is recorded in the correct period, and there's nothing from the next period showing up. So you want to test, there's some testing can satisfy, one test could satisfy multiple control objectives. The purpose of testing controls is to determine what type of and how many substantive tests you're going to do. If you test controls and there's good controls, which would lead to a low control risk, then you can do smaller size samples for substantive testing. If there's poor controls, which would lead to a high control risk, then you would have to do larger samples and more work at year end. So let me just show you. Exhibit 4 has some procedures that we can look at for control testing. So let me just show you Exhibit 4. So here, Exhibit 4 goes through what type of things can be done, and what control objective would it satisfy. So you can look at a sample of shipping documents and scan for any missing shipping numbers. Okay. You can trace to the related sales invoices. So you can take the shipping documents and then a sample of those, and then find the related sales invoice. If there isn't a related sales invoice, then that's a question that you have to further ask why there isn't. Maybe there's a gap in the internal control. You can scan the sales invoice for any missing numbers in the sequence. So if there's pre-numbered sales invoices and 1 or 2 or 3 or 4 of them are missing, then you would have to look at that in more detail. You can look at the sales journal, perform any recalculations like of discounts or like quantity times price. We can vouch from the sales invoices to the shipping documents, right, to determine if they're valid. Accuracy is something we're looking at when we're recalculating something to make sure that it's recorded properly. We can vouch the prices to the approved price lists, right? So whatever prices are on the invoices, we can compare them to the approved price list. We can look at the credit approval, if there was a credit approval obtained on that particular client. We can take our recorded cash receipts and vouch them to the deposit slip and the remittance list. We can trace them back to the bank statement to see that it showed up on the bank statement. So lots of stuff that we can do. When you're developing procedures, so when you're developing procedures on test of controls and on substantive procedures, you want to make sure you're very detailed in your procedures, and you want to state the risk that you are, what the risk is. There could be a risk that not all customers are having a credit report. So that would be the risk. Then you would state what control objective you're satisfying. So in this case, authorization. And then you would explain your detailed accounting procedure or audit procedure, sorry. So the audit procedure needs to be really detailed, more detailed than this, of exactly what you're going to be doing. So the step-by-step process of what exactly you're going to be doing, and the way that you should be explaining it should allow another person looking at your explanation, they'll know how to go out and do the audit procedure. All right, so let's go back to the slides. When doing substantive procedures for the revenue, receivable, and receipts process, we're going to link it to our audit assertions, right? So when we're looking at test of control procedures, we use control objectives. When we're looking at substantive procedures, we use our assertions. So audit procedures should gather evidence that the account balances are not materially misstated at year end. So procedures include recalculation, observation, confirmation, inquiry, vouching, tracing, scanning, and analytical review. Okay. Sometimes we can gain evidence doing a substantive procedure and a control procedure with the same test. So we could do that. When we are doing our audit procedures, we use an audit program. So we use an audit program, which is basically like a working paper of how you record the, it shows basically all the audit procedures you're doing and what assertions you are satisfying. Okay, so let's look at an audit program so I can show you what that looks like. So exhibit 11-5. That's right here. Okay, so this is an audit program for the cash balance. Okay, so this would go in like the front of your cash section file. Okay, so you would have like a lead sheet, which is going to show what the cash balance is this year compared to last year. And then this would be in there too. Okay, so the financial statement period, what the company name is, cash balance. So you first have to answer the questions around what's the fraud risk level, so moderate, no indicators of fraud, but cash is vulnerable, so the risk is moderate, so more than low. Okay. So you have to answer these questions. What are the inherent risk level at the assertion level for any of these? Okay, so it seems that there's a moderate risk for existence, completeness, ownership, a high risk for presentation, a low risk for valuation. If test of controls have been assessed, what is the assessed control risk for all of these? Okay, so there's a high risk for valuation and presentation, but low for everything else. And we're reducing detection risk by performing substantive procedures on all of these assertions. So let me just continue showing you the rest of this. Okay. Then you start doing the substantive procedures. So there's a list of procedures, and you would do the procedures that are necessary for your audit to provide sufficient evidence that to reduce the risk of material misstatement. Okay, so you would show what are the assertions related to the audit procedure. What the timing of when you did it, the extent, like the sample, and then whatever the working paper reference is to show where the backup is for that audit procedure. Okay. So existence, completeness, ownership, valuation, and presentation would be these letters. Okay. So we're going to prepare a lead sheet with a list of all cash accounts, current and prior year balances, tie it to the general ledger. Okay. So these are the assertions that they fit with. That's 100% is what was done. So it was 100% of all the cash accounts, like the total cash balance. And that's the documentation reference. So A1 is going to be your lead sheet. And then they developed, they did some analytical procedures. So lead sheet's A10 for that. Obtain confirmations from the banks. So confirmations is one of our audit procedures. Okay, so they did that. Review the bank confirmations for any loans, collateral guarantees. So these are just all the procedures that you would do. So trace the bank balance on the reconciliation to the bank confirmation. Right. So whatever the bank balance says on the bank reconciliation, make sure that matches with the bank confirmation. Trace whatever the book balance it says on the reconciliation to the general ledger. Sample outstanding checks and outstanding deposits. So they did a sample. They did the 10 largest checks. Right? So it's basically all the types of procedures that we have to do, and what is it related to? Is it related to existence, valuation? So when you're recalculating something or figuring out if the amounts are correct, it would be valuation, for example. And then the last page here. Okay, so last page continues on with a bunch of other audit procedures. Okay, so this is a good way to kind of get an overview of what type of procedures that you would have to do on the cash account. After you're done, you would say, based on my professional judgment, evidence is sufficient and appropriate to conclude the risk of material misstatement is low. So if they didn't find anything, it could be low. They're going to sign it off that they prepared it and what the date is, and then somebody has to review it and the date that they've reviewed it. Okay, so this is a typical audit program that would go into your audit file, and you would have to show, it's kind of a summary of all the audit procedures that you did and what assertions do they meet. And then you would link it to your working paper files to show where the evidence actually is. Exhibit 11.6 and 11.7 have a similar audit program for the AR balances, so the AR account, and then 11.7 for the sales revenue transactions. Okay, so just a special note about the existence assertion. For accounts receivables and other assets, we want to make sure that they actually exist. So more than completeness, completeness isn't as much of a risk as existence is for the revenues and accounts receivable. You're going to do computation for the assets that have calculations. You would do inspection of physical assets. So you can look at the actual inventories. You do bank confirmations. So look at the bank accounts, receivables can be confirmed. You can look at assets that are at other locations, right? So you might have to, if you do a physical inventory inspection, there might be several different warehouses and locations. So you want to go to a number of those, depending on the sample size. Inquiry, we can inquire with two agreements of some things that have like minimum balances, right? Basically, you're just inquiring in order to get the information to determine what your next audit procedure is going to be. We can examine title documents, any collateral, We can look at any misclassified assets, any overpayments, like when you're scanning the revenue account, for example, everything should be credit in the revenue account. So if you see any debits there, that might be something that you want to look into more detail for. And then we can do a comparison of assets to related revenues and expenses, compare expenses with revenues, contra revenue accounts with revenue accounts, right? To see what's, the typical sales discounts that are being provided. Are they similar to the previous years, or is this one year have a lot of sales discounts when other years didn't? So that's something that you would question further. We also use confirmations as an audit procedure. So for cash and loan balances, a bank confirmation is sent to the bank to ask what the deposits look like. Is it what the overdraft amount is? Are there any loans or contingent liabilities? So just to show you what a bank draft confirmation looks like, this is a bank confirmation being sent to West Country Bank, and this is what they have to fill in. They basically have to fill in any loans and other direct and contingent liabilities. Okay, so they have a $2 million operating loan of credit, the rate, due date, and then it also talks about what deposits and overdrafts they have. So, they have 368,202 in their bank balance. They have a US bank balance as well, a money market. Okay, so you would have to look at this and compare it with a bank reconciliation to make sure the amount is correct on there. There's also confirmations of accounts and notes receivable. So you can send out a confirmation to the customers to determine what the accounts receivable or notes receivable balance is or should be, and then compare it to the balance that the company has. Okay. Confirmations are used for existence and valuation assertions. There's two types of confirmations, positive confirmations and negative confirmations. So we did talk about this in chapter 8, but a positive confirmation requires a response in all cases, whether the balance is correct or incorrect. So it says, state what your balance is that you owe the company A, B, and C. And then we would take that and compare it with what the AR balance is. A negative confirmation only requires a response if a customer disagrees with the balance. So it will say, the balance that you owe company A, B, and C is 100,000. Provide us a response if this is not correct. So positive confirmation is the better one because you're asking for a response in all cases. So you don't know with a negative confirmation if the response is coming because of that they disagree, or maybe you didn't get a response. And does that mean that they agree with the amount, or they just didn't bother to provide a response? Okay, so positive confirmations are the way to go. The auditor needs to control the confirmations. So the auditor will make sure that the customer actually exists. Maybe they can do a Google search on the customer and the address of the customer to make sure the address is correct. The auditor will get the confirmation back sent to the auditor's address. Okay? So we just make sure that the auditor controls the confirmation, not the client, because we don't want the client to tamper with the confirmation before we get it. Bank reconciliations are audited 100%. So the bank balance is confirmed with the bank, like I showed you the confirmation. The reconciliation is recalculated, refooted. Reconciling items are vouched supporting documents. And we would get the bank statement directly from the client's bank. Okay, so we want to make sure we audit this 100% because there is a lot of errors and stuff that can happen with this account. We also need to make sure that there's no fraud happening with the accounts receivable balance. If auditors know the type of fraud that could be going on, then they would look out for that, right? Look out and make sure they test for that. So there's something called lapping that can happen, which is manipulation of accounts receivable to cover a theft or fraud. So in this case, somebody would steal, an employee would steal like accounts. If if a client is paying off their accounts receivable balance, the employee will steal that money, and then when the next client is going to give their accounts receivable balance, they'll clear off the first client's accounts receivable, and then keep kind of doing that and doing that and doing that. So we want to look for a customer that was credited their accounts receivable when no payment was received. Okay. There's also kitting that can happen, where an employee will, do an insufficient funds check, but once that's discovered, they'll do another insufficient to funds check, and before that could be discovered, people will think there's no issue. So the auditor needs to review all the interbank transactions or transfers that are happening. Okay. So that's basically the revenue cycle, and we need to understand the revenue cycle in order to determine what type of audit procedures we're going to do around the revenues, receivables, and receipts process. Okay. All right, thank you for listening, and take care.